Hi, this is Mike Bonfrisco, and I'm taking through a new workshop that I've been preparing called Gearing Up and Staying Calm during this market crash. So we're going through a market crash right now, and they happen from time to time. The last one was in 2008, and so we're going to use some of the lessons we learned in 2008 and previous crashes so that we know what to do now. So the best lesson is our own history, so we can move forward in a calm way. Okay, so what we're experiencing now is a market crash. So what do we do? What should we do as investors? Should we get out of the market? What changes should we make in the middle of this crisis in the market or this downturn in the market? But really what I'm trying to do is transform or change the way you think about how these crashes occur to you or how you respond to them. You have a choice with how to deal with this. You can get nervous and panicky, or you can see the silver lining in this type of thing and see how you're going to benefit from this in the long run. So if you knew that you could benefit from this market crash in the long run, then you would feel more comfortable about what's going on now. All right. So I'm going to use the analogy of flying in a plane. So we know that when we fly in a plane, sometimes there's turbulence. And in fact, a lot of people are scared of that turbulence, and they're scared to be on a plane in general. In fact, 25 million Americans suffer from fear of flying, right? Now, the thing is about turbulence and fear of flying is that it can really create manifest symptoms. And you might even have to take medicine to calm yourself so you can get on a plane. And it's particularly bad when we're experiencing turbulence. You know, the plane feels like it's never going to stop being bumpy. But what you need to understand is that the plane is engineered to withstand those forces. Actually, many times more force than you could ever feel it with turbulence. The plane has been over-engineered. And essentially, it's designed to bend but not break. The wings will bend, but they don't break. And your portfolio is designed the same way. It's engineered to deal with market crashes. And so the market goes down and your portfolio will respond to that. But it's not going to break, all right? It's going to navigate through the turbulence. So crashes happen, all right? They've happened before. They're going to happen in the future. Fear is worse than any crash. And crashes create opportunities. We'll see how that is in the future, in this workshop. So what is a crash? Well, it's a market decline of more than 20% across broadly across the whole market. And we're experiencing one now, so you can see what I mean by that. We've had this happen before, and every time it's happened before, the market's recovered. Most recently in 2008. Historically, when the markets crash, it recovers in months, not years. On average, it's about 9 or 10 months. Sometimes it's shorter, sometimes it recovers quicker, longer, but that's the average recovery for a market drop. So we know that over time, the market's going to give us 10%, but it doesn't do it exactly 10% every year. Some years it's up 20%, some years it's down. 3 out of 4 years, the market's up. That means 1 out of 4 years, the market's down. Right? The problem is that when the market's at an all-time high, often it backs off. It pulls back. And sometimes it crashes. This one is caused by the coronavirus. Okay. Back in 2008, it was caused by sloppy banking practices. In 2000, it was caused by the tech bubble. In 1987, it was because the market was overbought, meaning that the market was in a bubble, right? In the 70s, it was caused by an oil embargo. What causes all these crashes was different, but what was common about them is that they all recovered similarly. The crashes were caused by different things, but they recovered in a very similar way. What will set off the next bubble or the next crash? Well, that's unforeseeable. We just don't know, right? That's why you have to have a portfolio that's designed to deal with a crash, right? That'll give you more peace of mind. Some folks are even saying that this time it's different. Nothing will ever be the same. It will never be normal again. I remember hearing that in 2008. A lot of people were saying that. And when I went back into the research, they were saying it in all these other crashes as well. All right. So when the market drops like this, it's easy to say that things are never going to get better, but they always tend to. And since the 2008 crash, the market recovered and went on a 12-year upward run. It's been a very good run. All right. And so if you had $100,000 invested back in 1985 through all these crashes that I mentioned recently, you'd have $3.3 million if you had the S&P 500. That is a great return on your investment. Okay. And along the way, there's been a lot of ups and downs, and these little stars represent market tops. Okay. Market hitting an all-time high. All right. And it's going to hit an all-time high again. We just don't know when.
So let's get right to it. In today's market action, we have Mark Matson, Matson Money CEO. He's going to tell you how to get the highest returns from your portfolios no matter what the market's doing.
Mark, we are closing today at a 14-year high for the NASDAQ. Let's marry what Scott Bauer said with how you feel about whether people should be in stocks.
Well, what happened was, in 2008, 2009, a lot of people got panicked out of the market, and they've been waiting for this period of certainty where they know for sure that it's safe to get in. But guess what? That period is never going to come. Just because we're at an all-time high doesn't mean anything about the near-term future.
So in there, Mark Matson was talking about how when we're at the top, it's unpredictable what's going to happen tomorrow. Well, we can say that about any time, right? It's unpredictable when this rebound is going to occur in the market as it is now. But one of the worst possible things an investor can do in a down market is panic and sell. Investors are often seeking a perfect time to get into the market or out of the market. But what we know is that those who just stay with it do far better, all right? Because in order to time the market, we have to guess right 2 times. We have to get out at the right time, we have to get back in before it's on the way back up. I remember in 2008, people, in March of 2009, when the market was at the bottom, people were saying that it was going to go down further. All the experts on TV were not optimistic. Yet the market turned. It's unpredictable. And when it rebounded, it comes up suddenly and very quickly. And 6 months ago, no one could have predicted this coronavirus crash, right? It's unpredictable, all right? And that's why we often say in the short term, the markets are random. I don't know what's going to happen in the next 5 days in the market, other than it's going to be volatile. Historically, the market rebounds off these incidents, and it will recover. So people often say, well, gee, Mike, I hate all this volatility. Can't we just figure out a way not to have the volatility? Well, we're in the plane right now, and I'm telling you, there will be turbulence. We're going to experience some turbulence. And so at least we're telling you to expect volatility over the next few weeks or so. Nervous investors need to remain calm. It's calm in the face of this panic that will do you the best, all right? Because you don't want to make a decision based upon emotion and fear. Panic is your enemy. Because if you sell at the bottom, you create a massive transfer of wealth to the people who are calm. And there's traders out there who are praying that you're going to sell because they benefit from that. And so most people have heard the adage, you buy low, sell high, but they don't do it. At the end of this quarter, we are going to sell off the stuff that's high and repurchase the stuff that's low. And when the market recovers, which it will, those stocks that are low are going to race back up, and the rebalanced portfolios are going to do better than if we hadn't rebalanced them. So sometimes we say that it's easy to buy a diversified portfolio. What's the problem is sticking with it. We're long-term investors, and so we stick with it through the crashes. So the crash isn't the problem. It's the fear, right? And we don't want to try to time the market. Here's what I mean. Look, an S&P 500 index investor back in 1989 who bought the market made 10% return over time. But the average American investor who market times only made 4%. The same thing is true of bonds. The average bond investor who stayed with it did fine. But market timers got killed. The average investor market times. What we need to learn is that we need to stay with it, because when it rebounds, it's going to come up sharply. Investors are terrified of stocks during these volatile times. And the reason for that is because fear and pessimism sell on TV, right? And there's 2 players out there that are ready to destroy your peace of mind. The first one is the media, and they want your attention, and they will always overhype. It'll always be the worst or the most or the biggest, right? They did it in 2008. and it drove investors to cash out. And they're going to do it again right now. The other one is the traders. Now, traders make a lot of money off of the ups and downs, the volatility, the market traders, not investors. I'm talking about the guys up on Wall Street whose job it is to make money off of the volatility. So they want the volatility. When they have an opportunity to push the market around, they do, because they make a lot of money that way. And the only person they can make it from are people like you and me who fall victim to their fear tactics. So they're bullies, and they're going to bully you into making a dumb decision. So you don't want to do that. This dysfunctional narrative destroys investors' peace of mind.
And then there's the uncertainty of the election. I mean, I have my Trump hedge on. In the event Donald wins, I have.
So in that clip, really quickly, I was showing you that Mark Cuban was predicting that if Donald Trump won the 2016 election, that the market was going to drop. But up until the March of last year, we can see that a $100,000 investment grew to $140,000. It went up even more before the recent pullback. So predicting what's going to happen based on an election or a virus or anything else is a fool's game. No one can do it, Mark Cuban or anybody else. And the media loves to write articles to incite our fear. And people like to sell books to do the same, right? Because people buy this. It's been an age-old thing that fear sells, all right? Now, but investors who missed the upturn from the 2008 crash missed a huge drive up in their portfolio. We can see that investors, for example, who put $100,000 in at the bottom, March of 2009, and rode this up for 12 years, made $400,000 over the period of time. That's a huge win for investors who stayed calm, right? So assuming you have a globally diversified portfolio, which you do, what would it take to destroy it all? Well, nothing could destroy it all. Nothing. Short of a nuclear war or alien invasion, okay? Because the market's always recovered in the past, and there's no reason to think that things are different now. The world is not ending today, and the crashes actually create opportunity. Some clients are calling asking if now is a good time to get into the market. They have cash sitting on the side, and they want to buy in. They want to ride it back up. See, they see the opportunity. All right. Historically, one of the best times to buy equities is in a crash. Stocks are currently on sale. They're selling for less than what they were selling for just a month ago. And so you can buy those same companies cheap, good companies like Apple and Coke, Ford, companies that you know. They're selling cheap right now.
Every time the market crashes, if you're an investor, you should be thinking opportunity, opportunity, opportunity. I buy now when everybody's panicked. Long term, that's a wealth transfer to people who are smart enough to be long term.
Don't you wish you could train people to not run when prices get cheaper?
So here we see Mark talking on a TV show about how you want to stay calm during these market crashes. And in fact, smart investors often buy during the crash. So it's appropriate for prudent strategies to own some stock, diversify, and rebalance your portfolio quarterly, which is exactly what we're going to do. All right, and we use short-term fixed income, which are treasuries, to help rebalance the portfolio. And if the portfolio is not the problem, us making foolish mistakes in the middle of the panic is the problem. It creates a long-term destruction, comes from panic. In life, it never pays to panic. Panic is the enemy to prudence that will destroy your dreams and your future. What to do in a market crash? Well, don't panic. Understand that no one knows when it's going to crash is going to occur or when it's going to rebound. We want to pick a portfolio that we can live with no matter what happens in the future. We want to keep learning and keep getting coached, watching videos, coming to classes when I have them. Stay focused on what's important, your family, of course.
Look, there are two things that affect the market going forward. There is rational movers, that's news, statistics, facts, and data. And then there are irrational movers, and that's emotions, instincts, and people just buying on fear and greed. Neither of those things are predictable in the future. No one has a clear sign on the new news, and no one has a clear sign on the emotions and people moving forward. That's why the market is perfectly random and unpredictable. but we know the long-term stint of the market is up. So we own the market. We don't try to bet and predict it. And of course, it's very possible that they're going to have good earnings and the economy is going to get better. I believe in freedom. I believe in the free markets. Entrepreneurs will take us out of this.
So we can see that when Mark talked about that, it was in the recovery period. It was right around December of 2009. And if you stayed invested there, you would have done fine. All right. We've survived crashes before, and we'll survive this one. And you're going to be happy in time that you stayed calm and you let the portfolio do what it was designed to do. Thanks for joining me on this quick video. I hope that it helps you. If you need to share it with a friend or a family member who's nervous about the market, please feel free to. If you want to talk to me, please feel free to call. We can talk. And if you have a friend or family member who wants to talk, I'm happy to talk to them as well. Thanks for sharing some time with me. Okay, bye.